Put on your seatbelt. Taxes are going up. In this episode, we're going to address the question, will the economic stimulus cause taxes to go up? I'm going to share with you why that's inevitable and what you can do to protect yourself when taxes actually go on the rise. So I'm Doug Andrew, and I've been a financial strategist for 45 years, but I've helped a lot of people save hundreds of thousands of dollars of unnecessary tax by using strategies based upon what's going on in the economy. But I have spoken over 85,000 hours throughout America. Every audience that I speak to, when I ask the question, how many of you think that taxes will likely in the future be lower? Nothing but crickets. I say, well, how many of you think they're going to be the same? Maybe one or two people raise their hands. And I say, well, how many of you then think they're going to be higher? And a sea of hands goes up. Because, hello, we have seen for decades government continue to spend and do all kinds of programs and stimulus packages. And so during any stimulus legislation, or bailouts. We've had these in the past. We've had them very recently where there may be an allocation of over $2 trillion that was approved by Congress in March of 2020. And what happens is people think, oh, that sounds like a lot, but they don't realize. Do you know that's about half of what the IRS collects in an entire year? They are shelling out half of what the IRS gets in an entire year. So what does that mean after the money is shelled out? Well, some people say, well, they'll get it back with taxes. You're right. But to recoup all of that, taxes are going to have to go up dramatically. So the General Accountability Office and the Congressional Budget Office says, you know what? Taxes are going to have to go up just to cover not only the stimulus packages and those bailout programs, but hello, in every single political climate, we have proponents that say, hey, we want to have health care for all. They call it Medicare for all, which is really a misnomer. But hello, that's going to cost a ton. In fact, it's estimated that will cost maybe $90 trillion. We have others who say, well, let's forgive all student loan debt. Let's have college be free. Sounds wonderful, but where's the money going to come from? Rising taxes, and we continue to see all kinds of issues where the baby boomer generation are retiring, and that's a much bigger group of people than the upcoming workforce. Did you know that? And so Social Security, the government owes over $130 trillion in future Social Security and Medicare benefits. Where are they going to get the money? The working people is where they withhold it from, but that working class is a smaller group than the ones who are now getting the benefits. So hello, would you agree taxes will be going up? So what should you do? I've been blessed to author 11 books thus far, and now I have a goal to write a book every year the rest of my life. And in all of my various books, I talk about the deduction reduction when people retire. Because I've noticed that most people seem to be going down the highway of life. The destination is retirement or financial independence, let's say. But they don't realize they're going down that highway with one foot on the gas pedal, but the other foot is on the brake. And people say, what do you mean? Well, a lot of people who sock away money in traditional accounts like IRAs or 401ks that are tax deferred, and they do that because they thought they were going to be in a lower tax bracket when they retired. And frankly, that has not been true, or what I say axiomatic, just automatically assumed for over 25 years. But people still are duped into doing this. How many? 91% of Americans are, I think, duped into thinking that they're going to be in a lower bracket when they retire. And they have this deduction reduction because they've had the other foot on the brake their entire lifetime. For example, many people in retirement no longer have a house payment. They've paid off their house, which is a nice goal, but you've killed that tax deduction, the interest deduction there. You also cannot deduct your children, even if they're still living at home. You cannot deduct them as dependents anymore as adults. A lot of retirees are not contributing money anymore to IRAs and 401ks, TSAs and 403bs and 457s. They're all the same. And so you don't have that deduction anymore. And if you're a business owner, you've lost those deductions unless somehow you continue to own that business. But guess what? Congress keeps raising taxes because they have this need to continue to spend and get bigger and bigger and try to provide more and more for the general public, that maybe it would be better if they provided for themselves, is my opinion. But this is why we have this deduction reduction. So I've seen people retire, even school teachers, and it's so sad because the first 2.5, 3, at least by 5 years of retirement, most people pay back every dime they saved in taxes on the contributions, the contribution years, 30 or 40 years they've been contributing to IRAs or 401ks. They pay back every dime they saved in tax on the contribution in the first 3 to 5 years of the distribution. And they keep paying it back every 3 to 5 years the rest of their life. I ask people, whose retirement were you planning, yours or Uncle Sam's? Because Uncle Sam has been your partner all along the way. So when I say that Uncle Sam, or 41 out of 50 states also has a state income tax, so it may be the governor too of your state. But see, the government has a permanent tax lien on your tax-deferred IRAs and 401ks. They are your partner. Whenever you have a partnership, that means the other partner gets a piece of the profits. And I found that most retirees have had a partner that gets usually at least 1/3, and I think in the future that's going to climb to 50 and 60%. There are already many states like California that I meet people that shell out at least 50% of their retirement cash flow to the government in taxes. And so the government has been your partner, and I don't think you would go into business with a partner that said this: hey, let's go into business. Here's the deal. You do all the work. I get 1/3 of everything that you will ever realize when you sell this business. But you can't sell it before I tell you. If you sell it before age 59 and a half, I'm going to charge you another 10%. But if you do not sell the business and start giving me money out of it by age 70 and a half, and now, by the way, that rule is age 72 on IRAs or 401ks, you must withdraw the money. I'm going to penalize you 50% on that. I'm in control, but hey, should we go into business and do that? And what? Who would ever go into a partnership and give up choice and control? But I just described an IRA or 401k to you. And so the government has a permanent tax lien, which means this: if you accumulate $900,000 in this account, that's not all your money. Only about $600,000 of that is your money. If you have $600,000 over here, only about $400,000 of that is your money. The other $200,000 belongs to who? The government. And so why do you want to continue to have a partner like that up to retirement and thereafter? That's why I'm a big proponent of doing strategic rollout, not a rollover. A rollover is like going from the frying pan to the fire. That's like putting a 401k rolled over into an IRA. No, you get it out of the IRAs or 401ks, get the taxes over and done with sooner than later, reposition it into something that's going to be tax-free from now on and doesn't have all the strings attached that an IRA or 401k has. So I implore you not to go down the highway with one foot on the gas and the other foot on the brake. I mean, I know some elderly people that do that, but I wouldn't recommend it. That means don't continue to put money into traditional tax-deferred IRAs or 401ks thinking you're going to be in a lower tax bracket when you retire, because if you're in a lower tax bracket, it means you likely didn't save very much. Is that why you want to be in a lower bracket? No, you want to get the taxes over and done with sooner than later. Accumulate your money tax-free. Am I talking about a Roth? A Roth is a step in the right direction, but what I have is often referred to by savvy CPAs and tax attorneys as the rich man's Roth. It's called the Laser Fund, and so I wrote a book about it. When you click on this episode, you'll learn a little bit more about why the Laser Fund is referred to as the rich man's Roth. You don't have to be rich to have one, but rich people can't own a Roth. This has the 2 benefits of a Roth and 4 additional benefits Roths will never have. So watch this episode and learn more so that you can be empowered.